Bank of England raises interest rates by 0.75 percentage points. Please use the sharing tools found via the share button at the top or side of articles. Copying articles to share with others is a breach of FT.com T&Cs and copyright policy. Email licensing@ft.com to buy additional rights. Subscribers may share up to 10 or 20 articles per month using the gift article service. More information can be found at https://www.ft.com/tour. https://www.ft.com/content/70E4EBDF-AC70-4C9F-84070B60. The Bank of England has raised interest rates by 0.75 percentage points to 3% in its most forceful act to tame inflation for 30 years, but signaled that borrowing costs would not rise in the future by as much as markets expect. The pound fell 2% against the dollar, which had been buoyed by a contrasting message from the Federal Reserve that U.S. interest rates would increase by more than Wall Street anticipates. Warning that the outlook was very challenging and forecasting a long recession ahead, the UK's central bank issued unusually strong guidance that interest rates would not need to rise much further to bring inflation back to its 2% target. "We can make no promises about future interest rates," said BoE Governor Andrew Bailey. "But based on where we stand today, we think rates will have to go up by less than currently priced into financial markets. That is important because, for instance, it means that the rates on new fixed-term mortgages should not need to rise as they have done." He added that the BoE's rate-setting Monetary Policy Committee would not pursue an interest rate path that will drive inflation sustainably below target. The BoE's move matched the Fed's 0.75 percentage point rise on Wednesday and an identical increase by the European Central Bank last week. Raising rates to 3% took the UK's official interest rate to its highest level since late 2008. It is the largest increase since 1989, apart from a swiftly reversed rise on September 16, 1992, known as Black Wednesday. 7 of the 9 MPC members voted for the three-quarter-point rise, saying in the minutes that a larger increase at the meeting would help to bring inflation back to the 2% target sustainably in the medium term, and to reduce the risks of a more extended and costly tightening later. But their guidance and the economic forecasts published by the BoE suggested a dovish outlook for UK interest rates. The BoE laid out 2 possible scenarios. In one, interest rates would rise to 5.25%, leading to 8 quarters of contraction, the longest recession since the Second World War, and inflation falling to 0 in 3 years' time. But in a strong signal that it believes it may have already done the bulk of the work needed to curb inflation, the central bank highlighted an alternative scenario in which rates do not rise any further from the current 3%. In this scenario, inflation is projected to peak at 10.9% in the fourth quarter of 2022 before falling to 5.6% at the end of 2023, 2.2% at the end of 2024, and below its 2% target in 2025. However, even if interest rates stay on hold at 3%, the BoE still forecast a recession for 5 quarters, based on higher energy prices and mortgage costs. The BoE said the majority of the MPC believed that further increases might be required for inflation to return sustainably to target, but stressed that recent market pricing for the peak in interest rates had been too high. When the BoE closed its forecast in the run-up to the meeting, investors had been betting that rates would top out at 5.25%. Markets currently expect rates to peak at 4.65% in September next year. The BoE estimates that 2 million mortgages will reach the end of their fixed term by the end of next year, with those with an average-sized mortgage of £130,000 having to pay £3,000 more annually to service their debts.